On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to Hatfield Economics. I am your host, Todd Schoenberger. Joining me as he does every time this week is Jay Hatfield. He is the CEO of Infrastructure Capital Management, as well as the CIO of ICAP ETFs, including the fabulous QVol ETF, and we will get into that in a little bit. Jay, I want to start off the show about oil. Oil is just soaring today. We're seeing it in all of the big oil companies, including the refineries. Everything is up. West Texas Intermediate is just soaring. I know this goes completely against your thesis because you had really forecasted lower oil prices. What gives for today, and is this what we should expect for the rest of the summer?
Thanks, Todd, for having me back. Well, we think so. Our call is within the next month, we'll get below 60. We correctly called the move to 70. I do think 70 is a big inflection point, so we might bang around 70 for a while. The reason we're up today is the Revolutionary Guard attack to oil tankers. It's unclear what the U.S. response is going to be. As I say to anybody who cares, I got a C plus in my Iranian studies class at Wharton, so you kind of never know exactly what's going to happen with Iran. But it does seem that this was a bit of a rogue move on the IRC's part, and that's why you haven't seen a response yet from the Trump administration. But we're continuing our view. Strait will remain open either by force or by negotiation. It only needs to be about half open for us to have a glut of oil because of the pipelines moving to the west that have been operating at full capacity, and the Chinese reducing demand by about 4 million barrels. So we think the surplus will increase over the next 30 days and we'll get down to 60, but that's not to say we won't get attacks like this and we trade up above 70 and below 70 before we get a trend down to 60.
So the war itself is, and we are talking about after the memorandum of understanding was signed, that there is this ceasefire that's going on to hopefully be a long-term peace deal. Now that all of that's taking place, and you're right, other than the events of yesterday over the last 24 hours in the Strait, do you think Wall Street might be not, do you believe Wall Street isn't pricing geopolitical risk at the level that it should be?
We don't believe that. A lot of other people do, to be fair. Most, and CNBC validated this, most strategists thought oil would be much higher, like $20 higher for longer. So they're totally wrong. Failed to realize that OPEC would go to maximum production. But our $60 target really has $10 of geopolitical risk in it. Because with OPEC producing full out, that's more like a $50 oil price. And the Chinese conserving, for now at least. So we don't think so. We think that there's maybe, for political reasons, a lot of bearishness about oil prices. And to be fair, it is difficult to predict. Like, who knows what's going on internally in Iran between the Revolutionary Guard and other factions. But we do think the U.S. can keep the Strait open sufficiently to supply the world and keep oil prices under control. And frankly, let's say that we're wrong and we just hang out around 70. That's totally fine. We'll still get 3 months of negative CPI. Be nice if refining capacity or really, refining stocks, refined product stocks increase. It's probably not going to happen until after July, after the driving season, because that, gasoline's what goes into the CPI, not oil. And gasoline prices are high because cracks are high, or refining margins are high, in other words. So even if we just bang around 70, maybe 75, 65, whatever, as long as refining margins get gradually better. It's important to keep in mind that we're in a seasonally strong time for energy prices during summer, and they normally crash in August and September. So downside risk is definitely the predominant risk right now for oil.
Mm-hmm. hmm Do you think, well, let's talk about with lower oil prices. Do you believe that low oil prices is a much bigger catalyst than, say, lower interest rates for the stock market?
I would say that lower oil prices are a catalyst for lower interest rates, and that would be a further catalyst for the market. We think by the end of the summer, most strategists' targets will look stupid. Right now, when I go on TV, say 9,000, they kind of treat me like an idiot, which has not historically been the case. But if we get to normal, like this is not a rally. This is a rotation that we're having now, banging around the 7,500. I'd be surprised if we're not close to 8,000 by the end of the summer. And so, we're going to be much higher even if oil doesn't act perfectly and interest rates don't act perfectly.
Yeah, and we're never going to treat you like an idiot here, Jay Hatfield, that's for sure. But that 9,000 S&P target there, you have said publicly that you believe the risk is to the upside, that the number might not be high enough. Very bold statement by you, but why do you say this?
Well, just because I literally have to check the um, earnings estimates for 27 every time I go on an appearance, which I'm trying to do right now, which is um, because they just go up every day. And in fact, really, I'm not going to do this to be clear, but if I use 23 times 27 now, that would be 9,100. Now, I'm not going to raise it because maybe we end up the year at 22 and a half. In fact, what I think is superior about our research is not the opinion, but the numbers. So let's say you grant me and say, okay, well, I mean, you don't even have to grant me. It's on Bloomberg. It's basically $400 of S&P earnings, but you think we're going to be at 21 times. Okay. Well, it's 9,100 really at 23 times. So then your target's 8,300. So you can come up with your own target with our numbers. But I'm just saying already since the last time we spoke, we've got $100 of extra upside if we get to 23. I'm just going to capture that and say, well, the multiple will be 22 and a half or 22 and three quarters really. But this trend is not likely to stop. Like we're going to have another round of earnings in 2 weeks. Estimates are likely to go up. 27 earnings estimates will go up, and that multiple implicit in the 9,000 will drop. And keeping in mind that the equilibrium multiple for the S&P, even just in a normal market without AI and low rates, it's 21 times. So pick your poison, 8,200 to 9,100, I guess. But that still implies a pretty significant power rally during July.
Yeah, and I believe you. I mean, I see that where I can see us hitting 9,000, and that is a conservative estimate. And it's easy for the pundits to roll their eyes because we haven't even come close to that level yet. But personally, how does that make you feel though? Let's say we get into the end of Q3 going into Q4 and we are just a cat's whisker away from 9,000 and everyone is suddenly beating the drum, but you called it first. I mean, does that personally bother you? I mean, and what about, I'm sure your investors know, but do they then say, "Oh, so and so is validating what you said and that means it's more important?" I mean, it's got to be a personal
I
hit.
mean, we get some credit on places like Bloomberg that are a little more thoughtful.
Hmm.
Other places don't really care. They're just like, oh, Jamie Dimon, CEO of JP Morgan, he thinks that the world's coming to an end. And they treat it as if it means anything when he's the worst forecaster ever created by humans. So
Yeah.
most journalists, they more just say, well, what's the get? Oh, we got Muhammad Al-Arian. Okay. Forget that he's just basically BSing in a British accent. But so they don't really care about your track record. I'm going to go on CNBC. I picked on Thursday and I picked Marvell. It's up 162%. I'm not even sure they'll mention that.
Yeah.
So they're just what's the flavor of the day, how big a name. and they don't really care what you say. And they definitely don't really care if it's accurate or not over long periods of time. But to your point, our clients do. We have some great clients. They often, I don't remember everything I say exactly when I said it, but they will remind me of the things that have worked, like Marvell, for instance. A lot of our clients have that individually in their accounts, not just our ETFs. And so thankfully, our clients care and follow us more closely, and they don't get Muhammad Al-Arian to go on their channel or something, so they don't sort of judge us that way.
Right, right. Let's talk about Marvell Technology. So you're right. Since you recommended it, the stock up roughly 165%. You were the only one on Wall Street really calling for this. What did the rest of Wall Street miss?
Well, most of Wall Street, particularly not during earnings season, is completely momentum driven. The reason for that is hedge funds lose their capital if they have a bad month. In fact, an old colleague of mine just lost his capital at Millennium. And so you have to be a momentum trader. You can't be, well, this isn't, KKR. We like, well, it's not working now, but it's going to work in 2 years. That doesn't cut it. You're going to lose your job. So they are 100% momentum driven. So if Marvell gives conservative guidance, and the CEO said 2 weeks later, I gave conservative guidance because I was trying to maintain confidentiality, right? If you blow your relationship with these hyperscalers, you're out of business. But they didn't care and just stayed shorted. But they're growing at 40%, trading at like 16 times earnings. Like that's a 0.3 peg. So they don't usually care about valuation. That's why, by the way, this chip trade got way overdone in June. Arguably, the chip companies were trading near fair value, but everything else is super cheap. Like Amazon's was at 230, Netflix went down to 74.
Yeah.
They're just shorting because they have to be market neutral. So they want to get long Micron, they got to sell something, short something. And so that's how I knew that trade was overdone. Not so much like we're underweight Marvell right now, just because the chip trade is overdone. And we have a 350 target, but that's a pretty aggressive target. I'd rather be in Amazon, Netflix. Broadcom is a chip company, but way undervalued. It's kind of like the new Marvell, trading at about a 0.6 peg. So you just have to kind of arbitrage the hedge funds and take advantage of the fact that you have a longer horizon. We have more like a year or two horizon, because that's like we can underperform slightly for a while, and our clients will be patient with that. And we're always making money from writing calls. So, we might hold, a stock that's not working like Broadcom, but we write a bunch of calls and they all expire and we make money while we're waiting. So anyway, just beware, particularly in June, the month before earnings, all these trends get overdone. So don't get too caught up in that. Don't get too distressed if your favorite company just gets hammered every day, because it's probably a buying opportunity.
Right, right. It's truly tremendous. With the rotation, you brought up semiconductors and the chips. So, with the chip trade and the rotation out of that sector, where's the money going?
Well, it is going back into the hyperscalers, which is sort of the Mag 7, except Tesla.
Hmm.
Tesla's kind of more correlated with SpaceX, and I don't know what. It's a $50 stock, so not exactly some more of a Musk meme stock. But the Mag 8, which includes Broadcom, were sold pretty heavily. Broadcom now is trading as a chip stock, which is unfortunate. But everything else, like Google, Amazon, Meta got oversold. So that's what the rotation that the hedge funds were doing. And it's way overdone. Those companies are all bargains. Our favorite, as I mentioned, are Amazon and Netflix, but Google also. So just a big opportunity created by short-term oriented investors overdoing one trade, and they're doing it during a time where there's not net money flowing into the market. So I think that'll happen. So, maybe chips aren't going to outperform, but they might do okay, because if everything's rallying, like we kind of had everything rally yesterday, then, there won't be this hedge fund selling chips and buying and opposite should like all companies should benefit because there's nothing wrong with the chip companies. They're just closer to fully valued. They're not like ridiculously valued.
Yeah. Now, do you believe though that we may be entering a new phase of that AI investment cycle where software and cloud computing stocks are going to outperform semiconductor stocks?
I mean, I think maybe on a risk adjusted basis, probably, but these things also get underdone. Like it is unwinding as we speak. So at some point it sort of equalizes. And I do think they're doing well. Like I said, I don't think they're like massive shorts or you have to dump them. It's just that the mo is coming out of the trade. So I just think we're gonna have a more balanced market and less momentum driven, more like today, value stocks are working. So it's just gonna be pay to be long the market and preferably stocks that are reasonably valued, not SpaceX, for instance.
Right, right. And that's SpaceX. So
Not take
let's,
SpaceX ahead of lockups coming off and
okay.
ahead of the merger with Tesla. Because Musk meme stocks can go to infinity, but when there's negative catalysts, they usually don't do very well.
So why is SpaceX now that today it's included in the QQQs, it's down almost 6%? I mean, is it just because NASDAQ 100 is down or is there more to it?
It's just that the hedge funds and the street, Wall Street, they get ready for it. And then a lot of mo traders are like, oh, that's going to be a big catalyst. But when it's not, then they dump it. It's pretty
Hmm.
normal activity to have it rise when it gets added and fall when it gets announced that it's added, and then fall when it actually gets added.
Mm-hmm. Mm-hmm.
So
Let, let,
that's the normal pattern. So you should trade it that way. It might
oh,
sometimes do differently. And as you pointed out, part of it's a high beta stock and the Nasdaq's down. So it's not,
yeah.
they're only say half of it's down 6% ish. So probably half of that. Like if nothing was happening today, it would be down 3. So only part of it is just the normal inclusion cycle.
Yeah, yeah, and it's still not down to its all-time low yet anyway. So, but I see what you're saying. So let's talk about the Q vol though. With the Nasdaq volatility yesterday, today as well. How's Q vol doing? I mean, a 12% yield is truly remarkable, but is it impacting the portfolio structure?
Well, it's not, I would say, like today, per Bloomberg, do your own work. We're outperformed by 50 basis points. And the reason for that, is of course, we exclude the dogs of the deck, but that actually probably hurt us a little bit today because they're just doing nothing. But we're not in Tesla. We took the chip trade off. We were benefiting from that. Now we're slightly underweight chips. And we got, longer than Netflix, the companies I mentioned. Amazon's our biggest overweight, not just our biggest position, but you have to look at the over and underweights. So that trade's working. Writing calls is very profitable. It does allow us to stay in certain trades. Like we wrote some calls on Amazon, which were pretty far out, pretty far high up. So it's not actually hurting us yet. So that combination continues to be successful. And our objective, and you can hold us to that, is to beat the QQQs on a total return basis, because otherwise we're not really adding value. Like it's really dumb to take QQQ risk and get returns less than the QQQ just because you're getting income. Like you don't want that. I would counsel against, even if you don't buy QVol, don't buy in equity income funds that don't beat their indices, because that means they're subtracting alpha or subtracting performance by writing the calls. You need to do it in a clever fashion. So you have way more expiring, or the expirations offset the fact you cap gains, cap some of your gains.
Yeah. Now, and you mentioned Netflix. You're long Netflix now. I mean, the stock completely plummeted once its last earnings report. It was a big miss, and the stock just went off a cliff. Do you think it's oversold though? I see that we have rebounded a little bit. We're back over the that $75 mark, but and but still down 16% year to date. Is now a good time? What are your thoughts on the company?
Well, we did think so, and we just added it recently when it did get annihilated. It's trading at 20 times 27 earnings, and it's growing. My Bloomberg's slow. There we go. It's growing at 20%, sorry. So it's a one peg. NASDAQ's a 1.3 peg. Great company, low beta. Like it's not like AMD that goes up, $50 a day and down $50 a day. Its beta is less than the market, so it's less risky than the market. Well, that's really low for tech stock. So the combination of just what investors thought were disappointing earnings, but were fine, and then the attempt to buy Warner Brothers set the stock into a tizzy as well. And then the third thing, which is what we're really playing, is it's just this hedge funds relentlessly selling everything that's not chips. And so that's why we really bought, is we thought that trade would unwind and that would be a catalyst, which has worked. And so we're up on that trade. But it's not as exciting. Like if we're correct about Broadcom, like that could go to 600, it's at below 400. Netflix, I think our target's 110, so there's some upside, but without risk, no return. Broadcom has a 2 beta, and this is a below the market beta. So it's a little bit boring, but sometimes it's good to be boring.
Yeah. And you are right about with Netflix, how you had hedge funds that were selling. That does make a lot of sense. I've had a couple of people on from Silicon Valley who have recently said, if you go anywhere, all the talk is about AI, and that's where all the money and attention's going. Even Bitcoin has been seeing some selling as a result of people just pulling money out and going into the chip sector. So it makes a lot of sense. I completely agree with you.
And keep in mind too that rationality occurs during earnings season, because hedge funds usually cover, because some of them cycle, like Steve Cohen usually cycles his exposure up during earnings, and so the hedge funds unwind, and so all the nonsense attenuates. And then, by the way, they put it back in August and September, and we have terrible markets. But the same thing happened in March. Everything got way out of whack, created some huge opportunities. But just to be fair, it's not that fun while it's happening.
Yeah, no doubt about that. I know it's tough to stomach, but it will rebound. Like you said, it's a good company, so we'll see what plays out later. All right, Jay, I'm going to leave it there. We'll meet again next week. Next week, the 14th, the all-important CPI number comes out. You have a very aggressive forecast calling for a negative CPI. I assume that forecast has not changed?
Still negative, and like I said, we don't need to get to 60. Would help if by the August and September, we're going to have lower gasoline cracks, almost certainly, because there's a seasonality to it. So all systems are go on low CPI prints, and then later the numbers reflecting reality. So we don't need to be quite perfect on our $60 oil forecast.
Okay, I like that. Well, we will be breaking it all down. We actually have a new time next Tuesday. It's going to be 1 o'clock Eastern live on BTT. Definitely invite the audience to join us then as Jay gives his full analysis on that all-important CPI number. Jay, thanks again. Can't wait to see you next week.
Thanks, Todd. Great to be back.
Absolutely. So on behalf of Jay Hatfield, I am Todd Schoenberger. Thank you once again for joining us on Hatfield Economics. Until next time, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.